Okay, we're going to start today by looking at the Yahoo Finance main page. You can see we're a little bit mixed today in the stock market. Um, Tech stocks going down a little bit and S&P down a little bit, kind of break even. Um, we had um, we had some major things going on this week. Um, we had an emergency intervention by the Chinese. Their banking system seems to be under pressure and they're doing a stimulus to their economy. And you can see that in our front page news, let's look at some good news here. Okay, you can see in the news we have a lot of continued interest in the rate cuts by the Fed. Right now, we had a PCE reading that came out. It was kind of soft. That means inflation isn't growing as much. So it looks like they're not going to be cutting as much. And I guess that affects a lot of the interest rate sensitive stocks. Let's look at the 10-year. The US 10-year Treasury, you can see it's down. Um, that's a lot. Um, it's been going up steadily in the past week until today. So let's see. So right now we have we have a lot of the sectors in the stock market that are sensitive to interest rates. Um, you see, let's look at that. Okay, a lot of these, we expected, let's see, the 10-year Treasury is going down. We expected interest rate sensitive sectors to go up. So let's look at, we have home construction as interest rates go down, houses are more affordable and they sell more homes. So that's why the housing sector is going up. Biotech is appreciating because a lot of biotechs need money to borrow money to exist and to grow. So as interest rates go down, their cost of operations goes up. So that's better for the small companies. Utilities, they're going up because there's a higher demand for yield in as interest rates go down. Same thing with telecom. Telecom you has a high yield. So as interest rates go down, people want to buy stocks like Verizon or AT&T that'll yield 4 or 5 to 8%. All right, so that makes sense. The ones going down the most are gold. That's surprising. Um, we have we have a lot of people interested in gold, and gold has been going up a lot recently because let's look at our gold chart. This is the Spider Gold ETF. You can see that it's hitting like an looks like a high, all-time high. It's overbought, and you can see it's in a steady uptrend. There's a lot of talk that gold is something you should put your money into these days because there's a lot of reckless spending in the world in foreign governments that are spending more than they should. Like the US government is spending more than it should, and there's talk that you have to have some gold in your portfolio just in case there's a currency crisis. Um, so I'm surprised the gold is going down today. But let's look at what else is going down. Technology is going down. All right, let's look at some more of our talking points. Okay, we're at the end of September. This is I put this purple mark at the end of quarter window dressing. So the last week of September, there's going to be a lot of people gravitating towards stocks that have done the best in the stock market this quarter so that they can report that they own the best stocks on their top 10 list. And the great thing about the end of a quarter is a lot of the companies will need to, a lot of the hedge funds, mutual funds will have to report their holdings. So right around October, we're going to be getting a lot of details about what really smart people have done with their portfolios. So we'll look forward to that. And let me see. All right, so if we look at their big picture, you can see that a lot of our indexes are overbought, and they've been that way for at least a couple of weeks. You can see this, the S&P is overbought, and let's look at this one is overbought, QQQs, um, defense sector. Okay, gold is overbought. Okay, see, every one of these is overbought and at the top of their range, basically. That's usually an indication that it's not a good time to buy, and the market is frothy. Um, okay, let's look at some more of our meeting notes. Okay, we're not going to have earnings in October. All we have for news is government reports, basically. And occasionally we get a couple news stories about what's going on in stocks. So October, although it's been um, the month where a lot of the big crashes have happened in the past, like maybe the 1987 crash and maybe 2008 financial crisis, it's been a positive month usually. So let's look at, you look, October, November, December have been traditionally good months. This September has actually turned out to be a pretty decent month so far. So it's bucking the trend of our negative expectations for seasonality, but the month isn't over. Okay, so I still have the rest of September as possible bad time to invest because we're overbought right now. And a lot of times when everyone's buying and everyone's excited and super greeting, that's the time you don't want to buy or do you want to sell. Let's look at some of our talking points. Um, the 10-year is going up this week. It's up 2%. Um, as I showed you earlier, it's appreciated a lot it has been going down. Let's look at the 10-year. It has been going down steadily as the interest rates um, as the Fed has telegraphed that they'll be reducing the interest rates. But in the past week, we've had this little uptick. Um, and now we're going back down a little bit. So let's look at this more of our talking points. All right, so the breadth of the stock market rally, we have 81% of the S&P above the 50-day, 78 above the 200-day. That's usually a sign of momentum. Whenever you have those 80%, you usually have this people buying and excited in the stock market. So basically, as a contrary thinker, you have to like, no, that isn't the time to buy. It's the time to sell or just sit on your hands. Okay, so our themes from the beginning of the year have been we know that treasury yields are going down. So, and we know part of our theory from the beginning of the year has been everything that performed worse last year should be better performing this year. Healthcare, telecom, financials, energy, and utilities was our prediction. Energy is the only sector that has not performed well. Every other one of these has done really good. We haven't had a reversion to maybe a lower PE for the S&P yet. Right now we're at 22, which is pretty high. So don't be surprised if we have a correction and we get to a PE of 15 in the S&P eventually. Right. Okay, so we are overbought at 92. This is super overbought. If you look at our 150-day moving average, you probably can't see it, but it's the green line right here. And we are paying attention to that now as it seems like a floor of support for the stock market. So if we're overbought right now, right here, there's a good chance that we're going to have support right here if we have some kind of correction. And there's a lot of people out there that are saying that we're at the beginning of a major financial crisis in the world. I don't know how long it'll take to play out, but we have the central bank in China that they're doing some stimulus this week, and it could be the first canary in the coal mine where central banks around the world are panicking because there's a lot of debt, and it could just be something we've never seen before in an investing world. So you have to really prepare yourself for something like that. Okay, let's look at yeah, we still have a correlation going where the 10-year treasury goes down and stocks go up. And let's see, right now we got an indication that the 10-year they're not going to be reducing rates as much in the next meeting because of our PCE reading today. Same correlation for the 2-year treasury. So now let's look at our major variables in the stock market. Okay, China stimulated their economy this week. They injected a lot of money into the banks. They're giving handouts to their constituents. And that'll make the economy in China improve. And the important thing when you think about oil is as the economies around the world, especially China, improve, the price of oil goes up because there's a higher demand for oil. So with all else being the same. So it isn't reflecting that today, but over time, as China is one of the largest consumers of oil in the world. So if the China economy is running hot and is very it's going up a lot. I mean, if the economy is doing good, then you're going to have a lot of oil usage. So this price of oil will probably be going up. And as the price of oil goes up over time, we're going to have inflation return. So high oil is inflationary. You know, that's our theme. So right now we see that oil is going down. So that theory hasn't happened yet. Inflation is still around 2.5%. So that's not that bad at all. And US dollar index isn't changing. It's going down over time, but it's not changing this week. Gold is up 4% for the past week. Gold is becoming a safe haven in a world where there's a lot of debt. And I've been reading some articles on Twitter that this guy, Jim Willey, he basically is saying the BRICS payment system is going to coming on pretty soon. That's going to be where the major BRIC nations are going to be using this system instead of the dollar for oil transactions. And if that happens, there's going to be a large demand for gold. And there's not going to be too many people buying the US treasuries. And that could lead to big problems in America. So I don't know how to prepare for this. I got to research this, but it's becoming, and this I shouldn't read this guy. It makes me scared. The clock is ticking. The next big move in gold won't be a gradual rise. It'll be a quantum leap triggered by a financial system reset. I don't know if this happens, but I'm researching and I'll let you know if I figure something out. But if you have a situation where there's a crisis where America has higher interest rates they have to pay on their treasuries, and there's hyperinflation, there's not too many places to hide. And gold is probably one of the one places that can house a sense of stability over time. But I'll research that. That's something I don't have to worry right now. Let's kick that can down the road, as they say. All right, so what are our talking points? You can see the US dollar is going down over time. And traditionally, that's good for US stocks that do business overseas. But you know that reduces the value of the dollars that we have in the bank. Fear and greed index. We're at almost extreme greed right now. Um, and whenever you see extreme greed, you want to take some caution and don't buy, don't take on big positions and try to take some profits off the table or don't buy. And investors are getting less fearful. We can see that also um, in the AAII survey that they're becoming more bullish every week, amateur investors. And you see the VIX is going down. So people are less and less fearful. Um, so it's down to 15 right now, which is really low. So right now we're basically at the top of this paradigm. We're back to greedy, extreme greed. Um, Most investors pile on whenever they see momentum in the stock market and everything's going great. Um, and that's the time in when you don't, I mean, if you think contrary, you don't want to be investing at the top. Some of our issues that may lead to a crash. Um, this this global currency crisis. This has the highest probability right now of leading to a major market correction. The lack of um, stability of the dollar, and if nations like China stop buying U.S. treasuries um, and we have global currency problems, that will cause the major correction. China still has a housing crisis. They injected a lot of money in the banks this week. Um, they bailed out their economy with the stimulus, but there's still a shadow banking crisis in China. And I don't know what's going to happen there, but we'll see. Um, all right, so I'll keep an eye on that. I'll have to research some more. I don't know what the ramifications of what China did this week are. Let's look at, let me see. Okay, let's look at our first to worst. We started this at the beginning of the year. At the beginning of the year, we had the performance of last year. We had IT the best, communication services, then consumer discretionary. Utilities, consumer staples, energy, and healthcare did the worst. So this year, look at this. Utilities went up 26% this year so far. That is almost the best. So it is the worst at first. Consumer staples are up 16%. Energy is the worst performing sector. Um, and financials up 20% too. IT and communication services both are doing pretty good. And hold on for a second. Okay. And now, so this is actually coming to fruition, or worse the first. Utilities had a big set of information this week. We had a nuclear power plant for Constellation Energy going online and giving all of their energy to Microsoft. So there's a huge demand for energy, and I think that's not going to stop. So our themes for this year: weight loss drugs. China, we have a new thing: China stimulus boosts China stocks. I think this I don't know. This is a theme we have to watch. China stocks and all the affected stocks in the stock market in the United States that are affected by that. Um, Let me see. The AI revolution continues to be on the front page every day. Data centers, demand for electricity, and securing the grid. There's still themes that are working today. Let's see. Okay, let's look at the sectors, the stocks that are doing good and bad in the stock market now. Okay, market movers. We have Walgreens Foods Alliance. Okay. So we have the 10-year treasury going down, but what seems to be a lot. So we expect all stocks that are heavily indebted to do better because the amount that they'll have to pay to refinance their debt goes down. So let's look at Walgreens has more debt than their market cap. So they're huge borrow of money. Wynn Resorts, Las Vegas Sands are all heavily indebted companies that are getting a break today by lower interest rates. Um, let's see. A theme today for the top 10 are healthcare. We have Moderna, CVS, um, and Bristol Myers. Okay, these are stocks that are healthcare oriented. Um, let's look at ones going down the most. We see a lot of semiconductor stocks: NVIDIA, Broadcom, Lam Research, KLA, Tencor. Okay, these are related to AI and data center, and um, so that theme isn't working today. I guess what you'll find is, we're at the top right now of the stock market. So you have to expect, okay, so we're at the top right now of the stock market. People are going to, and a lot of the stocks that are tech oriented have rallied heavily into this oversold part of the stock market. So as we go in the next 2 weeks, we're going to have the stocks that appreciated the most in this time frame pull back, and the more conservative stocks, such as high yielding companies and utilities, do better in the next 2 weeks. So that kind of makes sense. And that this will probably be working. We'll probably have the same look in our market movers in the coming week or two as the high flying companies go down and the more conservative companies go up. All right, so let's look at what the Nasdaq is showing us today. Um, okay, it's basically the same thing we saw on the other screen. All right, so that doesn't tell us anything. Let's go back to our talking points. Okay, so let's look at Dan Now's picks from the beginning of the year. Amazon up 25%, Meta up 61%, Texas Instruments up 25%, K-Web is up 8%. You can see now that K-Web, all of the Chinese stocks have rallied significantly this week. This is the best week for Chinese stocks and since 2008, the financial crisis. So, and Dan's theme at the beginning of the year was reversion to the norm. These stocks, the Chinese stocks, have been punished for multiple years. And his theory was that a reversion to the mean will be eventually the market will notice that they have a very good valuations, and um, it, it would come back in favor. Same with the XBI. That was his theory with the small cap biotech has been out of favor for multiple years. So that's called a contrary indicators. I mean, contrary investing. And I think K-Web's um well, let's watch it over time here and see if it turns out to be a good performer this year. Okay, so here's a news story. It's a link here. Chinese stocks on track for the best week since 2008 after stimulus blitz. So China this week, the Chinese injected a lot of money into their economy. And there are some people that say it was like an emergency, like they were falling apart. Um, and so anyway, this is this could be a canary in the coal mine. If we have a crisis coming up in currencies, this could be like the thing that started everything. I don't know. I'm not smart enough to figure that out, but you have to make sure that you're um ready for something like a currency crisis. All right, so we had a news story on David Tepper. He basically he's a hedge fund manager, and in this link here, there's a video where he says it's time to buy everything Chinese, and he says everything. So that means he is very excited about buying Chinese stocks right now because number one, their stimulus, they're going to be supporting those stocks in the Chinese market, and there's going to be um, the companies are going to be buying back their stock. The Chinese government wants them to buy their stock back. So right now, the Chinese stocks are cheap and they're being supported by the government. This is and it's kind of sketchy because the government totally has their finger on these companies. They can make them successful or unsuccessful just by their policies. All right. So the easiest way to be buying everything in China is like an ETF, like KWEB or perhaps like a ETF for the country. Okay, here's an example of a stock we were researching last week on our screener, and it's gone up, good portion since last week. PDD Holdings. This was an example. Let's look at the screen from this week and see where PDD lies. This was in our top 10. It's a very large company. Its PEG ratio is 0.47. EPS long-term growth, 30%. Return on equity, 48. So all these numbers were really some of the best ones from last week's screen. But, it's really hard to invest in Chinese stocks because they're um, kind of manipulated by the Chinese government. So let's look at their growth rate. Last year to this year, they're up 82%, but I guess for this year and next year, they're growing 18%. The forward PE, let's look at the forward PE, is 9. So their PEG ratio is 0.5. So that means they're 50% off right now. And you can see they're growing, pretty steadily for the next couple of years. And you can see that they have really good numbers for all of our everything we need, everything we want. On top of all this, they have 284. They have almost double their market cap in cash, which is pretty outrageous. So they have a lot of cash. They have more cash than their current market cap. So that's a sense of stability. They not too many companies are in that situation. Return on equity is 45. Your profit margin is 28. So this is the company behind Temu, a lot of the Chinese websites that sell really cheap things to Americans. And here's another company, Alibaba. You can see that Yahoo Finance says they're 0.78 PEG ratio, so they're 20% off according to Yahoo. So the return on equity and profit margin isn't that great. So they're not really that profitable yet. So I wouldn't be that excited about this company. But you can see that they have $200 billion in cash, and their market cap is 200 billion. So they're almost have as much cash as their market cap, which is you don't see that every day. So the liquidation is, I guess, their liquidation value is worth more than what they're currently trading at. And you don't see that happening all the time. All right, so Alibaba, you can see that they're growing nothing from last year to this year. So they had a big problem. No, they're not growing from this year to next year. So that's a 0 in the growth rate. But after that, they should be growing 12%. So if their PE is 12, their forward PE is 12, their PEG ratio is around 1. So they're kind of fairly valued. All right, that was interesting to go through these. Chinese stocks are pretty sketchy, so you can't put a whole lot of money into those because they're at the whim of the Chinese government. 2 years ago, we were talking about Chinese stocks, and there were Chinese government officials capriciously making fines for these companies and making them follow certain rules that are not good for their company. So I don't know. We'll watch these, and we're already watching the K-Web from the beginning of the year. So let's look at some more talking points. Okay, so there's a new AI themed ETF, and that ETF is called LIVR. It's the LIVR ETF. It's an artificial intelligent artificial intelligence stock that basically picks stocks like um, famous investors. And we're going to follow this just to see how it does over time. It's supposed to pick stocks. Um, it basically picks stocks based on what the famous investors would choose, and a couple of different famous investors. So Stanley Druckenmiller, David Tepper, among others, Warren Buffett. And then it kind of puts them all together, and if they agree on the best stocks to buy, then that's what's in the top 10. So I thought it'd be interesting to go over the top 10 holdings and behold, PDD Holdings, the one on our screener from last week, and the one going up 10 or 20% this week, is the top AI pick for their fund. And let's look at what other ones. We can see a lot of the similar stocks that we see in the top 10 of our mutual funds we were following. And so I don't see any real surprises here. We have Tencent Holdings. This is a Chinese company. Um, we have All right. So like I said, a lot of these are ones we're already following anyways. So that's just kind of a good affirmation that our what we're following in our stock picks and the mutual fund holdings are similar to the AI, what Warren Buffett would pick and all these famous investors in this fund. All right. Okay. So there's another article on with Bill Nygren. He's a value investor. So value investors, they think of things in terms of 5, 10 years, 20 years down the line. They're not concerned about momentum. They're looking for stocks that are high quality, that are growing, and that are inexpensive right now. And what his theme for this talk in this link right here, his theme was that sometimes you have to buy stocks and expect you can't expect um, the price to go up, price discovery. And sometimes stocks you can hold them for 10 years and they'll still be adding value, but their stock won't go up. So he has a lot of stocks, especially finance stocks that he buys. He's really good at understanding banks. But he says there's not enough investors that are value investors. He says the lack of price discovery um, and the lack of people trying to find really good stocks instead of picking the momentum stocks, that's causing prices to be limited for a lot of the stocks that are good values. So he's not a momentum investor. He's more of a what is a stock worth if you back out everything and there's cash left, or everything of the company. So it'd be interesting to look at his stuff every now and then. One of his stocks that he likes the best is a stock called Corebridge Financial. It's a spinoff of AIG. I thought it'd be interesting to go through this one he talked about. Corebridge, they're a small company, so they're not as reliable as some of the big companies we're watching. But you can see that next couple of years, they're growing 15. This year, they grew 15% from last year, then 20% and 17%. So if they're growing 20% a year, their PE ratio now is 5. So they're 75% off, and they have a 3% dividend. So they're currently trading at $29 a share, and their true value probably is around 144. So the bad part is they're not really covered. They're a small company. They're not covered by CFRA, Morningstar, and a lot of analysts. So because of that, you're not going to have price discovery. It might sit at $29 a share for a really long time. But he's saying that they're buying back 20% of their float. So if you keep buying back your shares, eventually that price discovery is going to work out for where it's going to go up over time. So if you buy back 20% of the float, the earnings should be 20% better, basically, I think. So, but this is a small company. You can't really rely on that. You can see that the main numbers we're looking for, the small company at 18 billion, the PE is only 5 for PE, 11 for a profit margin, and return on equity is 16, which is pretty darn good. And they have a dividend of 3%. So the total return for that is it's pretty good, but you got to wait a long time for it to appreciate. Okay, so here's another talk from Bill Nygren. I sent the link on this meeting notes. All right. Hold on for a second. All right. So you can see that Google is his top holding. He believes that even if Google is broke up, it's some of its parts are worth more than what it's trading for right now. And it'll be years before any antitrust actions happen to them because there's appeal processes, and it just takes forever for that to be broken up or for there to be action against Google. Other ones, we talked about Schwab before. They're a bank and they're growing. They had a lack of confidence issue right when the banks were crashing last year. And they're still down a lot. And this is still one of his top holdings. What I did was I picked out one of the stocks that he has, Fiserv, that was in the news this week. And I thought it'd be interesting to go over that. Fiserv is a company that basically does their major product is allowing small businesses to do credit card transactions. So that if you go to a nightclub and you see an iPad with a enter your payment here, that's basically what they do with their Clover network. All right, so let's look at Fiserv. Okay, first of all, there's a story this week. Walmart, Fiserv team up to offer real-time payments. The takeaway from that is Walmart's a big company, and a lot of times they're a trend leader. And if other companies use Fiserv to offer real-time payments, in other words, they're taking payments straight out of the checking account somehow. I'm not sure. That's going to totally affect Visa, MasterCard if this is taken up in other parts, other big companies. So we have a potential Fiserv could be a competitor to Visa eventually. So that could be why Visa went down this week. But you can see that they're growing around they're growing around 16%. And the PE ratio is 17, so they're just about fairly valued. So the Walmart catalyst could turn this company to a competitor of Visa and MasterCard. If we see more news stories saying that, this direct transfer from banks is being adopted, maybe by Macy's, other big companies, that could be a big problem for Visa or MasterCard because they won't have to pay as big a fees for their transactions. Looking at Fiserv stats, we have $100 billion market cap. The PEG ratio is 1, which matches our numbers, and 17 and 11 in our return on equity and profit margin, which is it's decent. It's our low end, but it's still good. Related to that, we have the Justice Department accusing Visa of illegally maintaining a monopoly in debit card transactions. So Visa processes 60% of debit transactions in the US. So I'm not sure what's going to happen with this, but it's going to probably take years. I'd say UBS said Visa unlikely to be impacted for years from this suit. So let's see what happens. But this is like one canary in the coal mine that Visa has some competition or has some problems where they might have to not make as much money, with these debit transactions. It'll probably take a couple years for that to happen, though. But you can see we have another problem where they have possible competition from debit transactions from another company. So we'll watch that, see if it affects the long-term prospects of Visa. All right, so you can see Visa dropped 4% on the news or more on the antitrust news. But you can see that this 150-day moving average, the green line right here, it's holding right around that number. And it's also holding at the 200-day moving average. So and it's oversold. It's totally oversold right now. So it might even go down to this part, this trend line right here if it goes down more. Let me see. Okay, so I guess we can this little article here, there's a big AI theme that we've been following this year. This is a little illustration of all the parts of an AI data center. And a lot of these companies have gone up tremendously this year because of the demand for AI and data centers. So you can see that we have fabrication components, we have memory, we have networking, then integrators and core processor, customers, and end users. So this theme is the theme to the AI story. And what I like to do is I like to take and watch all these. And whenever one of these stocks goes down, as they do every now and then, like 20 or 40%, watch it and see if it's worth investing in. All right, that's all I had to say for today. I hope you enjoyed that. Hope you have really good returns next week, and I'll see you next time.